Welcome to the Small Business Tax Savings Podcast, powered by Jetro. Each week, we bring extremely valuable accounting and tax tips specific to small business owners. You will be on your way to growing your business and putting more money in your pockets. Here's your host.
Hello and welcome back to another episode. Today's topic is, what do I need to know about taxes as a business owner? Now, before we get into that, this episode is brought to you by the Tax Minimization Program, which is a training program to ensure that you pay the least amount in taxes as legally possible. I am your host, Mike Jesowshek. Again, today's topic is, what do I need to know about taxes as a business owner? And this is the 6th post in our Starting a Business series. And really this series stemmed from a conversation we had with a brand new business owner that was completely lost about what running a business means. And so it got me thinking. We talked to this through our free Facebook group and said, is anybody interested in us doing a full series on this topic? And this is where this episode came from. And again, this is the 6th episode of this Starting a Business series. Which reminds me, if you haven't joined our free Facebook group, join now. Go to Facebook and just type in Small Business Tax Secrets. There'll be a few questions you have to answer, and then we'll let you in where you can join in on the conversation that we're having with other business owners. And as we're going through this series, put your questions in that free Facebook group. Shoot us an email, ask@taxsavingspodcast.com. Let us know the questions you have around this topic. At the end of this series, we're going to be doing a Q&A episode where we're just answering some of those questions that maybe aren't meant for a full episode, but we still want to get some answers to. So as questions arise, be sure to ask them and send them over to us. Now, talking specifically about this topic, taxes are by far the most confusing and stressful part of being a business owner, which is why this podcast exists. My goal is to hopefully break that down for you, break down that confusion, break down that stress into small and easy to understand bites, which is oftentimes what we're doing on the Small Business Tax Savings Podcast. So to begin with, the first question we want to answer is, what do I need to know about tax from a very basic level at least? And if you remember back from episode 1 of this series, we talked about this idea of profit. And we discussed how profit is essentially your sales minus your expenses, and it then is eventually what you get taxed on. We also brought this big question: how much should I put away for taxes? And I mentioned how I never like to give a number because every single situation is different. However, in that same breath, I said that a very rough guide that you can use is to put 30% of your profit aside for taxes. For some, it's going to be much less, which means you'll get an extra, quote, paycheck or refund at the end of the year. But for others, it may be a little bit more. Your taxes might be a little bit more than 30%, but at least you have the vast majority of that tax bill saved away if you're putting that 30% away. So again, this is a very, very, very rough number, is 30% of your profit you can put away for taxes. That means you'll either be getting a refund or you might have a little extra bill at the end, but either way, you have some money set aside. By putting this money away, it will help avoid a major problem that we often see with new small business owners. They often come after year 1 with a profit with their newly opened business, but they didn't save anything for taxes. And now we go to file their tax return and they do not have any funds to pay for the taxes that are due, which spirals into future years, and they're always sort of playing catch up on last year's taxes. We want to try to avoid that, and that's where putting money aside is going to be your best friend. Next, we want to talk about is, how is my business taxed? And for the vast majority of businesses, there is no tax on the corporate level. Instead, the profits from your business flow through to you, aka pass through to you onto your personal return as the business owner, where those profits are then taxed at the personal level. Now, big note here, if you're organized as a C corporation with no S corp election, then you would have to pay taxes on the profits of the business at the company level. So keep note, if you're a C corp with no S corp election or anything like that, you would have to pay taxes on the profits of your business at the company level. All other entity structures are going to be a flow through or pass through to your personal return, which is where you're eventually going to pay the actual tax for it. So the basic concept regarding a pass-through is that if you have a pass-through entity, your income and expenses related to the business are reported on a business tax return. That could be a Schedule C, that could be a Form 1065 for a partnership, that can be a Form 1120-S for an S corporation. The profit from those businesses are then, from that business tax return, reported on your personal return, where you will eventually pay the taxes on it. So pass-through entities include sole proprietorships, partnerships, single-member LLCs, and S corporations. If you're operating as a sole proprietor or single-member LLC, your business activity would be reported on a Schedule C, which is simply a supplemental form on your personal tax return. So if you're operating as a sole proprietorship or single-member LLC, your business activity would be reported on a Schedule C, which is a supplemental form on your personal tax return. If you're operating as a partnership or a multi-member LLC or an S corporation, your business activity would be reported on a separate business tax return, where you would then get a K-1 from, which would bring the activity from that separate business tax return into your personal tax return. So you take that, you do a separate business tax return for the business, you'll get a K-1, and that K-1 reports that income, where you will eventually report that on your personal return and pay the taxes for it. Partnerships and multi-member LLCs are filed using Form 1065 of Partnership Tax Return, and S corporations are filed on Form 1120-S, an S corporation tax return. We also did a full article on this last year called Pass-Through Entities, and I'll put a link in the show notes to check that out. We'll also have a link in the show notes to an article on this topic that we're talking about today, which you can link out to that as well. So you might be thinking, what is this S corporation that you're talking about? And as we've been discussing throughout this series, if your business is profiting $50,000 or more per year, you definitely want to be researching an S corporation. An S corporation is simply a way to be taxed. It is not an entity type at the state level. And in order to be taxed as an S corporation, your business must either be an LLC or a corporation, and then you elect for that business to be taxed as an S corporation. And simply put, an S corporation is a way to help reduce the amount you pay in self-employment taxes. So we did an entire 6-part series on S corps last year. So if you are interested in that and you are in that profit range of $50,000 or more, I recommend that you check out that series. Again, we'll have a link in the show notes, but it's found at taxsavingspodcast.com/S corp. Now, a question we get often is, how often do I need to pay taxes? And business owners all the time think that all they have to do is pay taxes at year end when they file their tax return. However, that's not exactly true. The United States federal income tax is a pay-as-you-go tax, which basically just means that you owe taxes as you earn income throughout the year. Think of it as a W-2 employee. You'll have gross wages, and then your employer will take taxes out and submit them to the government throughout the year on your behalf. This is the same for a small business owner, except you don't have someone withholding those taxes for you. You're responsible for that piece. Even though you do not file your official tax return until year end, that does not necessarily mean that taxes are not due until then. The year-end tax filing is simply a reconciliation of what occurred throughout the year to see if you paid too much. If you paid too much, you'll get a refund, or you didn't pay enough, and then you'll have a little bit amount due. If you have an amount due, you may have to pay interest or penalties depending on that amount and what estimates you've made and some other factors. And this is why estimated taxes are important to think about as a business owner. Estimated taxes are pretty self-explanatory, but basically you take your expected profit and your personal situation and estimate what your tax bill will be so that you can make quarterly payments towards that eventual tax filing that happens at year end. Again, if you pay too much in estimated taxes, you'll get that back as a refund at year end. If you did not pay enough in estimated taxes, you'll have an amount due at year end and potentially have interest and penalties. So estimated taxes are important. You pay them quarterly, and again, it's just an estimate based on how your business is performing. We're actually going to be doing an entire episode on its own specifically on estimated taxes. So when are the tax returns due? There's two key dates we want to think about, and this is the original due date. So the original due date is when taxes are due. If we're unable to file taxes on that time, we can file an extension. We just need to make sure an extension is filed by that original due date. And there's two important dates, March 15th and April 15th. And this is where a lot of people get confused because they think tax day is April 15th, but they forget about that March 15th date. March 15th due date is when S corporation tax returns, partnership tax returns, and multi-member LLC tax returns are all due. So again, March 15th, S corp, partnership, or multi-member LLC tax returns are due, or an extension has to be filed by then. April 15th is when personal returns are due and C corporation tax returns are due. Now, personal returns include single-member LLCs. So if you're a single-member LLC, not taxed as an S corp, again, remember we're filing that on a Schedule C on your personal tax return. That's the April 15th deadline. So there is some logistics here. Let's say you're operating as an S corporation. You need to have your business tax return filed by March 15th, which you'll get a K1, and then your personal tax return would have to be filed by April 15th. Finally, what are some other business taxes that you need to consider? First off, payroll taxes if you have employees. And if you're an S corporation, you're going to have employees. And so we discussed payroll taxes, how those work, payroll software works in part 5 of our series, which was called How Do I Hire Employees in My Business? So if you missed that, check back one episode ago to that How Do I Hire Employees in My Business to learn about payroll taxes, payroll software, how the software takes care of much of that for you. You might have sales tax. Again, if necessary. Not all businesses are going to have sales tax, but you might be subject to sales tax. And we did a blog post and podcast on this early in the year called What Do I Need to Know About Sales Tax? So if you missed that one, check that out. Go back to that episode. And finally, you might have property taxes or various local taxes that you might be subject to based on locality. And this is kind of more on a local level. So I would check some of your local resources to see if you're subject to these types of taxes. So those are kind of the main things that we want you to think about as a business owner. Again, in summary, we talked about from a basic level, you pay taxes on the profit of your business. Revenue or sales minus expenses is your profit. A very rough number to use, again, very rough number to use, is to put 30% of your profit aside to pay for taxes. You might not owe that much and you're going to get a refund. You might owe a little bit more than that. And you're going to have a little bit of amount due, but at least it's a rough idea that you're in a fairly safe range. Now, your business, if it's a flow-through or pass-through entity, which is going to be your S corporation, your single-member LLCs, your partnerships, your sole proprietors, if you're a pass-through entity, you're going to pay taxes at the personal level. There's going to be no corporate tax rate. If you're a C corporation, then you will pay taxes at the corporate level. But if you're a pass-through entity, which the majority of small businesses we work with are organized as a pass-through entity, you're going to pay taxes on your personal return, but you might have a business tax return. So if you're operating as a sole proprietorship or single-member LLC, your business activity is going to be reported on a Schedule C, which is a part of your personal tax return. If you're operating as a partnership or a multi-member LLC or an S corporation, you're going to file a separate business tax return, which you'll then get a K1 from, which will be what you use to report that activity on your personal income, on your personal return, which is where you'll eventually pay those taxes. Partnerships are filed on Form 1065, and S corporations are filed on Form 1120S. Remember this S corporation talk, we typically say if your business is profiting $50,000 or more, you're going to want to start researching looking at an S corporation. We did a full 6-part series on this last year, so be sure to check out that series, taxsavingspodcast.com/S Corp, and I'll also have a link to this article in the show notes. How often do you need to pay taxes? You need to pay taxes when you earn it. So the United States federal income tax is a pay-as-you-go tax, which basically means that you owe taxes as you earn income throughout the year. So if you're a business owner, you need to be filing quarterly estimated tax payments on a quarterly basis to make sure you're eating away at the final tax bill, which you'll know exactly what the amount is during next tax season. Again, if you pay too much in estimated taxes, you'll get those back in a refund. If you didn't pay enough in estimated taxes, you'll have an amount due at the end of the year. If you end up having an amount due at the end of the year, there's a possibility that you might have some interest and penalties on that amount due. Now, when we talk about when returns are due, S corporations, partnerships, and multi-member LLC tax returns are due on March 15th. That's their due date or date that you have to have an extension filed by. And personal tax returns, including single-member LLCs on your Schedule C, along with C corporations, are due on April 15th, or at least an extension has to be filed by April 15th. Some other taxes you might need to consider are payroll taxes, sales tax, property taxes, things like that, other local taxes, which you're going to want to check out as well. So again, hopefully this was helpful for you to get a better understanding of how taxes work for small business owners and what you need to know as you get started down this journey. This was meant for a kind of high-level overview to kind of give you a heads up on some of the important things I want you to be thinking about as you're starting a new business. Now, we're going to continue this Starting a Business series, and like I said, we want you to submit questions to us. So go in our free Facebook group. Again, that's on Facebook at Small Business Tax Secrets. Send us an email at ask@taxsavingspodcast.com. If you have questions that you want answered, send them over to us. We might have a full episode on it, or at the end of this series, we're going to do a Q&A session where we kind of answer any remaining questions that are outstanding. So I want to thank you for listening to another episode, and I will see you next week.
This has been another episode of the Small Business Tax Savings Podcast from the team at Jetro. If you enjoy our weekly episodes, please leave a review on whatever platform you listen to us on and share with other business owners. If you have any questions or future topics you want to hear, email them to tax@jetrotax.com. Thanks for listening and have a great day.